Hey guys, I want to welcome you to the weekly Wednesday for the Financial Freedom newsletter, where every week, every Wednesday, we delve into something inspirational, motivational, something excerpt taken from the Financial Freedom weekly newsletter. Wherever you are, if you're listening on Spotify, on iTunes, Google, be sure to click the like, subscribe, share, comment. And without ado, let's get into the show. Hey guys, welcome to this week's podcast episode for the Financial Freedom Podcast. I'm really excited about today's guest, Ben Frazier. He's a CIO at Aspen Funds, and he's a seasoned financial expert with a passion for helping people make informed investment choices. So today we're going to be talking about our bread and butter topics: real estate, investments, financial planning, and I'm happy to welcome Ben to the show. Welcome.
Hey, thanks so much, Christopher. Thanks for having me on.
Yeah, tell the audience about your background, your experience, and then we'll get into what Aspen Funds does.
Yeah, great. Thank you. As you said, I'm the CIO at Aspen Funds, and so we invest across multiple asset classes, mostly in real estate, but also in oil and gas. And I've been doing that for almost 6 years now. And prior to that, actually started kind of in the finance world in banking. So I was a commercial lender and an underwriter for many years. And, kind of my origin story was, working in corporate, career ladder, and had a lot of success as a lender, and kind of hit the top of the ladder pretty quick and realized, this is great, but, I'm looking for some more challenges. And as I was, doing a lot of underwriting, and one of the cool things you get to do in that is get to look at the personal financial statements of every borrower that comes to the bank. And I've worked for several banks, and they mostly kind of focused on business owners, entrepreneurs, and kind of high net worth individuals. And so I got to see some of the most wealthiest, clients at the bank, exactly what they were invested in and what they did. And to me, it really kind of came down to two things, two commonalities that I noticed. One was a lot of them were entrepreneurs, a lot of them were business owners, and they'd created a lot of wealth through entrepreneurship. And the other was a lot of them invested in real estate, right? And lots of different kinds of real estate. But it really got me curious and interested and wanted to kind of go and forge that path. So I was fortunate to be able to join Aspen Funds about 6 years ago. And currently a partner, and getting to kind of build the platform that we've been building now for about 10 years, and getting to invest in a lot of different fun things.
Yeah, it's fascinating. I love that. I love, once you follow the money and you see where the wealthy people are investing, it's kind of eye-opening. And like you said, most of the majority of millionaires, multimillionaires, real estate is a huge component. They invest in there's different strategies. And so I always love talking with people who help these types of clients. So, talk about essentially, Aspen Funds, what was interesting is, is primarily real estate, but you also mentioned something in the green room, was that you're asset agnostic. And I'm really curious, for the listeners.
Yeah, well, it's kind of interesting because our business has evolved over the past 10 years. And 10 years ago, our founders started Aspen just kind of as an opportunistic thing. Hey, let's go try and make some money. They saw an opportunity in distressed debt, right? Distressed mortgages coming out of the great financial crisis. And it was a great time to get into that, right? There's a lot of it, and did very well. And we've been running that business, actually continue to for over 10 years. It's been a great niche. We continue to operate it, still are finding good product, but it's kind of plateauing, right? There's not as much as there was. It's kind of a counter-cyclical asset class, meaning that, there's more of it when times are bad than when times are good. It really kind of spawned this evolution of our business, which has always been very opportunistic. We always wanted to kind of be on the front end of economic tides, as we call them. So kind of the big picture trends that are going on in the economy, and positioning ourselves as investors. And so we started a podcast called Invest Like a Billionaire, where we've kind of just studied the ultra wealthy and try to figure out, what are they doing? How are they investing? What is setting them apart from the average investor? And a lot of them are investing very heavily into real estate, private equity, hedge funds and other alternative asset classes. And most of these ultra wealthy are investing generally around a quarter of their portfolios into public equities, right? Only a quarter, where most individuals, most high income earning professionals, they're investing mostly into their 401k and maybe into another account, and have maybe 90% into the public equities. So there's a very big divergence here, right, of how the ultra wealthy are doing. So we really tried to model what the ultra wealthy are doing. And so we kind of do what we call kind of a family office approach, where we're not so convinced that one asset class is the best thing since sliced bread and will always be the best thing since sliced bread, because as as investors intuitively know, things that go in cycles, right? There's certain times that are better to invest in certain asset classes than other times. And so what we want to do is position our portfolios and position the offerings that we're investing in with where we think the opportunities are going forward. So that's caused us to invest in a lot of different asset classes. We've invested in multifamily, industrial, self-storage, retail, and actually a few years ago started investing in oil and gas projects, which we're very bullish on right now. And so it's really kind of taken the constraints off, where a lot of people say, I'm just going to do multifamily syndications. I'm going to do that till I die. And hey, there's a lot of reasons to do multifamily. I love multifamily, but there's cycles, right? And there's a lot of concern in multifamily right now, which we could talk about if we wanted. But that's kind of our approach: is we look at these big picture trends, where we think opportunities are, how do we invest as investors and create a nice portfolio that's balanced across multiple asset classes.
And I know a lot of the audience out there, physicians, are really forward thinking. And there's this question, there's this, I think they're trying to delay the onset of the recession. There's interest rates. There's concern with commercial real estate. So where are you setting your sights on? What other strategies are you looking at? And how can people position themselves in your fund?
Yeah, absolutely. We're still bullish on multifamily. I want to be clear on that because, we do think there's opportunities there. We're just being a lot more selective, as I think most people are. And we're actually shifting our strategies within multifamily to be less focused on value add and more focused on development. And I can get into that if we wanted to, but the kind of big picture things going on, right? If you look at supply versus demand, we're seeing a confluence of a lot of things happening this year that I think is a little bit concerning for a lot of investors, especially in projects that were invested in, say, the last couple of years, because the last few years we saw this extreme compression of cap rates, right? Values for multifamily just went through the roof, especially in Sunbelt markets where there was a lot of population growth, a lot of good reasons to invest in those markets, but the kind of price of entry went through the roof. And what happened was, I think coinciding with that, there was what I call a syndicator bubble, right? There's, everyone and their uncles, raising money for real estate now, it seems. And while I think it's great to create more access, these types of assets, the challenge is a lot of these folks are less experienced, and they also used a heavy amount of bridge debt, which, if you're familiar with bridge debt terms, they're generally very high leverage. They generally have floating rate interest rates. They have short maturities, so they're generally 2 to 3 year maturities. Well, that's great in a bull market when everything's going up, right? You can kind of grow out of it, and you can, leverage is really, really good when you have things go well for you, but it can also be a really big challenge when things aren't. And so what we're seeing right now is all this demand that was kind of pent up, that was invested into the multifamily space. And now we have interest rates that are going up. That puts a lot of pressure on cap rates. And you have investors that are kind of concerned. You have a lot of these bridge loans that are now maturing this year. So there's a report that recently was published by Fitch, which is a ratings agency for a lot of the CMBS loans, so the commercial mortgage-backed security market. Right. So these are a lot of loans that are kind of done at a big level on multifamily, and they looked at kind of what's maturing this year. And 25% of the loans that are maturing this year, they estimated would not qualify for a refinance, but due to either leverage concerns or debt service coverage concerns, meaning there's not enough operating income at the property level to support a refinance, right? So that's a pretty big yellow flag, and if not a red flag. And What I think is going to happen, meanwhile, we have these kind of brooding problems on the maturing debt side of things. That's putting a lot of pressure on operators and sellers. And then you have a record number of completions being brought to the market. So there's a lot of development that happened a couple of years ago. It takes about 24 months to start bringing new properties to the market. And it's estimated that, right now through kind of the next, 3 or 4 quarters is going to be the highest number of deliveries of new multifamily units being delivered in recent history. Right. So that's also not great news for those that are trying to increase rent. So you have a lot of these factors that are putting a lot of pressure, negative pressure on these properties. But I think if you take a step back and look at like a 3 to 5 year time frame, we still have a massive shortage of housing units in the U.S. And so I think there's going to be some turbulence in the short run, but demand continues to be strong. And it's kind of softening. You're starting to see some of the Sunbelt markets are having negative rent growth year over year. But that's more an issue of a lot of supply coming into the market, right? There's a lot of new units being delivered. But I think over the next 12 to 18 months, a lot of that stabilizes, and I think it's still continuing to be a good investment. So kind of a major rabbit trail there, but I know a lot of people are thinking about that. A lot of people are invested in multifamily and are concerned. I think it's really understanding what are the debt terms at the underlying property level. What's the NOI? And, is there going to be some kind of plan B optionality for getting a refinance to ride through some of the potential turbulence in the next kind of 12 months? But all that to say, we are also seeing a lot of other opportunities, and especially right now, that probably number one asset class in real estate that we're excited about is industrial. And industrial is, it's been on a tear for the past decade. It's actually done very, very well. National vacancy, I think, is somewhere, it's below 3% nationwide in industrial, especially the newer vintages. And a lot of that's been caused by kind of e-commerce boom, right? So as Amazon has taken over the world and is shipping a lot of things, that has caused a lot of need for warehouse space. And so these kind of big box industrial real estate properties, there's been a huge amount of completions, but the absorption's been there. A lot of these are getting absorbed just because of all the demand. And so a lot of people are kind of concerned, hey, the end of the industrial era is kind of e-commerce as a percentage of retail sales is plateauing, right? It's probably got some room to run, but not at the same rate. A lot of people are concerned maybe it's, the writing's on the wall. But we actually believe it's kind of about to kind of hit another phase, the next level of booster rockets to get to the next level of orbit here in industrial, because there's a whole other trend that's happening that we think is a decade plus long trend. And that trend is deglobal and bringing manufacturing and inventory back to the U.S. So nearshoring and reshoring are two big trends that we started to see really the beginnings of the last year and a half. Just last year, it's estimated that there was $5 trillion of reshoring initiatives being spent domestically to bring manufacturing back to the U.S. and to bring inventory back to the U.S. in a lot of ways. And what's causing this, is somewhat kind of intuitive to investors that, went through COVID here and saw a lot of supply chain issues going on, a lot of just the issues that these companies were having in delivering product and getting things from overseas to the end consumer. And so what happened is it kind of created this massive disruption in the supply chain system, and the calculus for a lot of these companies has changed, right? Maybe I could, 10 years ago, produce things a lot cheaper, and kind of this just-in-time inventory system could get things right when I needed it. But now wages have actually gone up a lot. There's actually been a 15x increase in wages in China specifically. It's had the highest level of wage growth in history. I mean, it's crazy to look at, how much more expensive it's become over the past 15 years. And then, you kind of, I think companies underpriced the risk of the supply chain being disrupted, right? And so now you have, Ford manufacturing. I think they've, gotten through some of the issues, but they have still a massive backlog of inventory of trucks that they cannot sell. They're sitting on, lots, pretty much completed, except they don't have the little microchips to put in them. right? Because they can't get them fast enough. And so how valuable is it? I think the last I looked, they had, $5 billion worth of inventory that was nearly completed that they can't sell. How valuable is it to Ford to invest in, critical component manufacturing back in the US? Maybe it costs a little bit more for that one component, but it actually creates a whole lot more, consistency and reliability of their supply chain and delivering, the vehicles to the market. So, again, going a lot of tangents here, but we're very, very bullish on industrial, and that's probably our number one real estate asset class we're looking at right now.
And very fascinating. And then, so we talked about multifamily, industrial, talked about a little bit of the macroeconomic trends, and I know we have a few more minutes left, and I know, for example, a lot of people who may want to kind of do what the bigger players are doing. You talk about alternative investments and kind of go through kind of the categories and what the big institutions, endowments are doing, and with some of the advantages of getting into those types of opportunities.
Yeah, absolutely. So, if you're really curious, you could check out our podcast. If you want to hear some of the research that we've done, some of our earlier podcasts, we actually did a whole, laying out kind of the groundwork for this concept and some of the research. For those that just kind of want to get some really good data, get their hands on some good data, check out Tiger 21 Global. You might be familiar with this group, Chris. So it's basically a pretty cool group that you have to have at least $20 million of investable assets to join. And then what they do is they survey all their constituents, I think quarterly, and they will publish kind of an average portfolio allocation, pie chart. You've all seen those pie charts of what are you invested in? And they publish that quarterly. And it's pretty cool to see because these are very successful investors. You get a pretty good sample size, and they have several thousand members. So you have a pretty good sense of the reliability of the data. And you can look at, in the allocations, I've studied this over the past couple of years, they don't really change much over time, right? They're pretty, locked in from within maybe 5 percentage point swings on any, given quarter. But most of the time it's, 25 public equities, it's 25% real estate, 25 private equity. So not real estate, but you actually buying businesses, leveraged buyouts generally. And then the other 25% is kind of a mix, a lot of different things like commodities, cash, bonds, maybe a little bit of crypto, other things, right? So that's kind of been the allocation that we've seen pretty consistent. That's also pretty well mimicked by a lot of the big endowment funds, like Yale Endowment was a pioneer in this space. And so the kind of simple question is, well, if this is how the most wealthy are investing, why shouldn't I be doing it? And it's a great question because I would say most people should be, right? If you have a net worth of greater than a few $1 million, you can definitely, take some of the liquidity risk is probably the biggest risk that you're taking, meaning, the benefit of having all your money in the stock market, stocks and bonds, is you can pull it out anytime you want, but it's also a double-edged sword, right? Because we're emotional investors and it's difficult to time the market. So at a certain point of net worth, I think it makes sense to start allocating in a bigger way to these private alternatives. As far as access to private equity, that's probably one of the more challenging ones to get access to, just because it is kind of more consolidated with some of the bigger groups. I don't have a whole lot of recommendations there, but as far as the real estate goes, I know you interview a lot of different real estate syndicators, and most people probably know places to kind of get involved there. But yeah, that's kind of the basic approach that we've seen from most of the wealthy investors.
Yeah, really interesting. And how can people check out Aspen Funds? Check out your social media, you see the work that you do.
Yeah, the easiest way is if you like podcasts, you can check out ours. It's thebillionairepodcast.com or Invest Like a Billionaire on any platform you listen on. And then our private equity firm is Aspen. So you can check out that. We have a few offerings that are always live, and things that are going on that we kind of are excited about.
And for all the listeners out there, let's thank Ben for coming onto the show, talking about what his company does, kind of the macro landscape. All of his resources will be in the links and show notes. And thanks so much for coming onto the podcast.
Yeah, thanks very much for having me. It was really fun.
I hope you really enjoyed that wonderful wherever you are listening, if you liked it, be sure to like, comment, share, subscribe. We're on everywhere: Spotify, iTunes, Google, Amazon, Audible. And without much ado, be sure to thank this show's sponsors, and we'll see you next week.